Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Today we will bounce around to a few different charts. We'll look at CPI like you see here on your screen. We'll unpack that in a few different ways. We'll look at some growth rates of a few different economic indicators and how those compare to prior recessions. You've seen some of that before, but I've got a new way of looking at it that I think gives slightly different insights, but also some confluence. And I'll use these data points today to express what I think is an inflection point that we're passing right now from June to July of this year. I think that we're reaching a bend in the road for the immaculate disinflation story and that it has run its course. And what we'll see over the next few months is a tumultuous mix of latent inflationary strength mixed with economic drags from monetary policy still working their way into the economy. So we'll talk about those various components, and in upcoming videos, I'm sure we'll unpack it even more. So don't go anywhere, many things to discuss. But first, a couple of housekeeping items. If you enjoy my content, or this is your first time on my channel, please give this video a thumbs up and subscribe. I am a one-man operation. I make all these charts myself, I do all my own research, I edit my videos. Your engagement is literally everything to me, so please consider it, and I thank you. Second, none of this is financial advice. I'm just some guy on the internet. I do a lot of research, and I think I have pretty good perspectives, but I am not giving you any tailored investment advice. You should do your own research before putting your money to work in the markets. Now that we've got those things out of the way, I hope you're comfy. Enjoy yourselves. Let's get into it. So we'll talk about a few different things today, but where we'll start is with CPI. So the headline number came out this past week, and it's only 3%, which is pretty amazing. We haven't been at 3% since back here in March, April of 2021. This is the year-over-year value in black. And there are a few things about this we can take away. The first one is CPI is only 50% above the Fed's target. That's good. That's got people feeling bullish about policy. Maybe it's going to soften sometime in the near future. Too early to say that. But there's some elements to the CPI that I think, if you look closely, tell a slightly different story from just looking at the headline 3% number. So these other lines on the chart here are different rates of change. We've got it on a 6-month annualized basis, a 3-month annualized, and a 1-month annualized. Seeing these different slices of the rate of change inside of the year-over-year number can give you a hint to where that headline figure is going to get pulled toward, where the gravity is on the CPI. So let's first focus on 2022 here in the middle. The real main point that I think it's important to take away about the CPI is that we are just now, from June to July, passing a point where the year-over-year comparisons get a lot harder for the disinflation camp. So what do I mean by that? This blue line represents the month-over-month change of inflation, the headline number. And in the summer of last year, in June, that's when we got the biggest month-over-month jump. That was also the peak of headline CPI. That's when headline CPI peaked around 9%, 9.1%. And after that, it began its descent. And its descent was aided largely by headline CPI actually falling into mild deflation on a month-over-month basis, where prices ran up to a really extreme high and then pulled back from it just a little bit, but still remained elevated from where they were when the saga began. But the month-over-month figure was actually negative a couple of times in July and August of last year, and then again in November and December it was negative by a large margin. So the month-over-month change in CPI softened a whole bunch. It was like there was a blow-off peak in prices and they pulled back a little bit, not enough to push us into outright deflation from where we began, but enough to register on the monthly change as deflation. And that helped pull the headline figure down. At the same time, it was also pulling down the 3-month rate of change and the 6-month rate of change, right? They follow along a little bit slower. So all of these began drifting lower into the end of the year, and that pulled CPI down to about 6.5 by Christmas. So what is happening here in 2023? Well, that same series, the month-over-month series that was helping to pull down headline CPI by producing negative values on a monthly cadence, they're now updating on a yearly basis in the positive, around 4% on an annualized rate, which is, about 0.2, 0.3% month over month on average. So on a monthly basis, we're starting to form a little bit of a baseline here around 3 or 4% annualized, which is above the 2% target. And if we look at it on a quarterly basis and on a 6-month basis, it's really looking a lot more stable than where we were at the end of last year. Look at the difference in these lines. They were trending down really heavily into late 2022, and now they are pushing back up into the 4 or 5% range. This one in particular caught my eye, the 6-month annualized rate. It's all the way back up at 5.7%, just as we passed the period of time where we have the most difficult yearly comps ahead of us. Let me show you this in a slightly different way, and maybe it will click. So here is the month over month change of CPI. You see, this is how much it changes month to month to month. And this blue bar right here is June of last year. That is the biggest month over month change we've had in this whole saga. This was also the peak of yearly CPI at 9.1%. It's the same place as this point right here on our chart where headline CPI peaked and month over month peaked. That's what we're looking at right here. These represent those negative values. And for the CPI print that just came out this past week, everything that you see in blue is what composed the year-over-year change in CPI. Well, next month, when we get to July, this giant blue box will leave the yearly comparisons. And then for the next CPI reading in July, 33% of the 12 months inside of the yearly composition will have seen negative values, which makes it extremely hard for a year-over-year comparison to continue falling lower. It makes it much more likely that the July year-over-year CPI reading will be the same or possibly higher than the one we just got for June, if the dynamics that we're picking up on here from the headline value pushing up on a 6-month basis are coming to fruition. So what am I trying to convey here? My point is that we've just passed, as a result of this giant blue box here in June of last year, as we now pass June of this year, going forward, the year-over-year comparisons for CPI, which is the most common way of presenting that value, will have a much tougher job if they want to continue to print lower values than the 3% that we just saw, because the components inside of the comparison are much softer than the ones that we've just now exited from last summer, and because we're seeing on a 3-month and 6-month basis that CPI is starting to stabilize on a headline basis around 4 or 5% annualized. And if that's the case, then you can expect, if this remains a relatively stable trend, that the 12-month value, which is currently at 3%, will begin to chase this back up to 4 or 5%. That is the takeaway. We can see this dynamic in a couple of other places as well. So the Fed doesn't just look at headline CPI. That's what the media looks at. That's what FinTwit looks at a lot of the time. But there are other places where we're seeing a similar stabilization in rate of change. These are wages, average hourly earnings. On a year-over-year basis, it fell last year from about 6.8% down to 5.4%. Now we're down at 4.7%, but it's falling less quickly than it did last year. Wage growth is still almost 5%, and that's more than double the inflation target. We've talked about how wages and prices are intrinsically linked, so it's important that wage growth not continue to be so strong. But as we've talked about before, it's starting to stabilize on a 6-month, 3-month basis. Look at this, it's pretty flat. It's not starting to bow over in a really dramatic way like you would hope to see if the economy was starting to cool off and give the Fed a signal that they can stop being so hawkish. I think what we're going to find out over the next few months is that June 2023 likely marked an inflection point in the narrative of peak disinflation. The immaculate disinflation idea that took hold for the last few months, I think, has come to its conclusion. It's fully run its course. And over the next few months, as the economy remains a bit strong, as we see the last kind of gasps of excess consumer savings, and the lag of monetary policy begins to catch up with us, I think we will see inflation begin to rise again, maybe much more slowly than last year, probably a lot more slowly, but not falling down to 1% or negative values like some of the deflationists think we're headed towards. I I, in fact, think we've seen most of the disinflation we're going to see, and that going forward, it will be a lot more difficult for those values to come down unless we see notable demand destruction. So far, we haven't quite gotten that. We've seen weakness. We're kind of limping into the finish line here. We'll show some of that here in a minute. But some of these pieces inside of the bigger inflation story are not quite where they need to be for the Fed to be able to signal victory. Another place they often look is PCE, personal consumption. That's the one that Powell mentions most of the time, core PCE. Well, this is headline PCE, similar story. The month-over-month rate of change, it jumped a lot at the beginning of the year. Part of that was because all Social Security recipients got a major cost of living adjustment, and they had a huge impulse in spending. I think that helped drive part of this month-over-month change, and also it came from a pretty low value the month before. It had dipped kind of hard. But on a 3-month and 6-month basis, they're still a little inconclusive. 3-month looks like it's starting to slow down. It's down about 3%, but on the 6-month basis, look at that. It's basically stabilized at 6%. It looks like it's curling a little and softening. That's well above the Fed's target. And if we look at it on a core basis, that excludes food and energy costs from personal consumption, which is kind of silly because those are very important items for survival. But alas, if we ignore that, PCE on a core basis has stabilized pretty heavily around 4.5%. Now, part of that has to do with some of the lag in the methodology and the different things that they calculate. Nonetheless, on a 3-month basis, it's still over 4%. On a 6-month basis, it bounced in March and has risen back up to 4.6. So the story I'm telling across all these different metrics, CPI, wages, PCE, is that they're stabilizing in a bad way above the Fed's target. Headline CPI is actually rising on a 6-month annualized basis, which is not the story you hear when headline 12-month is falling. This value will chase these other values higher over the coming months. So I think peak disinflation is behind us. And the Fed's really trapped in a box here because they can't really declare victory in this environment. No matter who may think 5.25% Fed funds is a long-term ridiculous interest rate for the United States with these debt levels. Right now, that doesn't really matter. The Fed's response function is implicitly tied to inflation and labor's strength is currently derived in large part from the stubbornness of inflation. So for a central banker who finds inflation to be their worst enemy, they may see very few options over the next few months but to remain in their hawkish posture, which is not what the markets are expecting. People are expecting rate cuts over the next few months by the end of the year, and we may not see that catalyst, and once again the bond market will have been proven wrong and have to kick the can on their expectations yet again. They've been wrong for 2 years. Inflation can be so tough to read as well because it creates distortions in a lot of areas of the economy. It can make it hard to piece out actual, sustainable, real demand. And we've talked about over the last many videos as we've been talking about recessions, that there are certain pieces of the economy that are already drawing down and contracting in a way that suggests we're heading for a slowdown. Those things being industrial production, real manufacturing sales, real retail sales, right? And it's the two components of sales that I think are telling part of the story here, but maybe isn't getting much focus because there's just so much going on. And when you look at these two on their own, real manufacturing sales at the top, real retail sales at the bottom. Both of them peaked in the first half of 2022. January was the peak of manufacturing and trade sales. April was the peak of retail sales. And since then, both of them have failed to make new highs. However, during this same time, CPI has fallen. The peak was 9% right here in June, and it has come all the way down to 3%. Yet, these two values, which are adjusted for that inflation, have not made new highs. I said this on Twitter the other day, and I might have confused some folks. So let me give you an example of why this is weird to me. So these both represent sales, right? And let's say that they are just a simple number. Let's say that sales is the number 50. Let's also say that inflation is the number 5. Doesn't matter that what units these are. This is just a math example. So if you have nominal sales of 50 and you have inflation of 5, then you have real sales of 45. You subtract inflation from the nominal value that gives you the real value. This is what real sales is in our example. Well, what if inflation falls to 2? Well, if you had stable retail sales, you would expect that when inflation falls to 2, real retail sales would then be 48. Well, what have we seen? Here is real retail sales. Now, not only is it down off of its peaks, but it's continued to fall even as inflation has been falling, right? Same thing up here for real manufacturing sales. It peaked in January of 2022, and it's still at this level here that it was at in February and March. It hasn't really gone anywhere. Meanwhile, inflation went all the way up and peaked and has since trailed down. Now, it's up a little bit off the lows, but for inflation to have been cut in a third from its peak here in June, and for real manufacturing and trade sales to have only gotten 50% of the way back to their peak, says to us that the sales number is getting weaker. The nominal value is getting weaker, even as inflation is also getting weaker. Let's look at that over here. This is nominal sales, okay? This is not adjusted for inflation. These are all of the components of real manufacturing and retail sales. Here are retailers. Here's all the components, right? And what do you see? All of them are failing to make new highs. Retailers have stayed relatively consistent. It's still kind of trending up, I guess, from the lows back here, but over the last year and change, it's been in a relative stasis sideways. Manufacturer sales, their peak was here in June, and they have been setting lower highs and lower lows. Merchant and wholesaler sales peaked in June, again with inflation. So you can see how nominal values are strongly affected by inflation. This was the peak of inflation. It was also the peak for wholesaler sales and manufacturing sales. Wholesaler sales has shown a more precipitous decline. And in terms of total business sales, these other 3 lines all combined, you can see its peak was back here in June, and it's just been setting structurally lower highs and lower lows ever since for a year, even while inflation has been falling from its peak here. So inflation is falling, but nominal sales are also falling. So the real values are basically going nowhere. If inflation picks up again, as I have suggested it's capable of doing, even if it picks up just 1 percentage point, then you would expect both of these values to dip down lower because they're currently not showing much strength of their own. Now, one thing that we've looked at in previous videos is various components of the economy and how they're growing relative to prior yield curve inversions that led into recessions. And we had a bunch of different versions of this kind of chart where we looked at all the different metrics that we've found important: retail sales, manufacturing, incomes, industrial production, etc. And we noted that the 2022-23 era, with the exception of things like labor, is growing near the bottom in terms of rate of change of all pre-recessionary comparisons. And that gave me some concern that whatever downturn we head into might be kind of ugly and sluggish. But what happens if we make a composite growth metric out of all these different measures and look at it compared to high inflation eras and low inflation eras and all the prior recessions compared to today's period? So here is one of those comparisons. We had all the different individual metrics. Well, then I bucketed them together into things called cyclicals, income and spending, and labor. And they contain all of the smaller pieces that we've been studying over the recent videos. Cyclicals are the parts we already know are in contraction: industrial production, manufacturing, retail. Income spending is PCE and personal income. Labor is non-farm payrolls and household employment blended together. And then we've got all of them combined over here. And now in terms of dating, the black line is all eras from 1960 to 2010 in the 12 months leading up to the beginning of the NBER dated recession. The red line is 2022 and 23, and it's the last 12 months of data. And the thing you can notice, it's plain as day. We're below all of these black lines except for one place. Labor, the one place everyone is looking at for weakness, the one place that they are citing to say we can't go into a recession, look at all this job creation that we have. Well, it kind of makes sense that everyone is distracted by that, because that is the one place that is growing stronger than historical norms at this point of where we are in the cycle. Everything else, the cyclicals, which we've already made a very good case, are considerably weaker than where they should be, and we're just limping into the finish line in that regard. But also the income and spending components. And consider that this also includes the high inflationary recessions of 1968 to 1970, 1974-75, and the double dip 80s recessions with Paul Volcker. They're all included in here. And even with that caveat, we're still below them in real personal income and real consumption. Even though those eras had higher nominal inflation than we have now, we still have lower income growth on a real basis, lower spending growth on a real basis. However, labor growth remains pretty strong. I also ran a second comparison. I looked at the same composite growth rate, but then I split out the other eras by high inflation and low inflation. High inflation, I made 1968-70, 73-75, and the double dip 80s recessions. Everything else went into the average low inflation bucket, and then we have today. The x-axis is once again the time period leading into the recession, and the red line for today is just the last 12 months of data. And what you can see is, just like on the composite growth of today versus all prior eras, where we're growing well below trend, almost down into contraction on a composite basis, when we split out the different eras between the types of inflation we have to see if maybe those distortions put us in line with what the 60s and 70s look like, we can see we're even below those periods. With the exception of 1 month of data, which was earlier this year, we have been trailing below all high inflationary pre-recession comps. So let's take this same concept and let's apply it to the yield curve inversion x-axis comparison that we were doing with these other charts over here, all right? That's what this looks like. So we've got our rolling composite growth rate for this current cycle on a 3-month basis. And up here in black, we've got all the other eras all combined together from the point of yield curve inversion, which is right here. So we're showing a little bit from before it and then after yield curve inversion. Here's the start of all the recessions. They're out ahead of us. And as I've talked about before, it feels like we're right now in June and July of this year entering the sweet spot, because where we are on the data, this is when the 1973-74 recession was said to have begun. Now, that doesn't mean that the market was aware of it at this point, or that the people were aware of it at this point, but in hindsight, upon study, the NBER decided this was the moment in time when that recession really kicked off in earnest. And as you see up ahead of us, we've got maybe for the next year, the next 10, 12 months, we've got a big window of time where we have a lot of examples of recessions. And this isn't even all of them. These are just the ones we have yield curve inversion examples for. So we're approaching the sweet spot, and composite growth rates for this era here in red they're choppy on a 3-month basis. They are choppy, but relatively speaking, we're below prior eras and we're trailing downwards. You can see that over here as well. Some of you may recognize this chart from our recession series when we were looking at the different component indicators and how they behave on the way into the beginning of a recession, which is here at this vertical black line. And we noted how certain indicators, like the cyclical components of the economy, they grow much weaker on the way in, whereas things like labor, they can stay positive until 2, 3, 4 months into what we consider to be the recession. Well, here we are today in red compared to the composite averages of all of these other metrics. This is just another version of the other chart we looked at before with the various different colored lines. But here it's a way of seeing all of the comparisons all on the screen at once. And what you really want to be looking at is where the red line is compared to the black line. And what you'll see is that on 4 of the 7, we are trailing below the historical comps as of right now, though we have been chopping around a little bit. But generally speaking, we're following some of these down. We're setting lower highs. And up here on non-farm payrolls, we're following the growth pattern pretty closely. We're seeing growth in employment start to slow down on a rate of change basis, though it is still positive. Now, this doesn't mean that we're a month away from the recession starting. Every era is unique, and this black line is an average of like 8 different recessions. So you can't draw that kind of comparison and say, oh, well, we're just a month away. But what it does suggest is that we're very much entering the danger zone. As we've seen right here, here's our growth rate, here's the recession starts, and this is what it tends to look like afterward. Now, this is COVID wreaking havoc on my composite growth rate right here, but I can go take that out and we can see what it looks like. I'll just do this live on the video so you can see there's no funny business in the way that we do our data here. This is what it looks like if you take out COVID. We're still trending below the historical average growth rate of all these other recessions down here. So let's bring a few of my ideas from this video all together. As we noted, the month-over-month change of CPI just passed the largest change during this entire cycle. So the year-over-year comparisons from July onwards will get a lot harder for the disinflation camp. For the people who want to see headline CPI continuing to fall in a similar manner as it has all year long, that gets much more difficult because 4 of the 12 months inside of the yearly comparison will have been negative. As we looked at, rates of change on CPI are telling different stories. As the yearly headline number begins to fall, we see things like the 6-month rate of change accelerating back up to 6%, which suggests the Fed will be left at the altar if they're hoping to get a signal to pivot more dovish in the near term. I think CPI has a strong chance of beginning to stabilize above their target, and that could present more complications over the next few months. We also touched on the fact that the sales components of the indicators we've been looking at to judge recessions are showing a unique kind of weakness, where even as inflation has fallen, which should cause those metrics, if stable, to rise as a result, they have remained flat, and they haven't really been going anywhere. So we went and looked at all of the various components inside of those metrics, and we saw that they've been setting lower highs on a nominal basis, even as inflation falls. So some of the leading components of our recession framework show a special kind of weakness that even inflation is not able to completely explain away. And from a perspective of composite growth, by combining these various metrics together and looking at a more holistic approach to the economy, we're trailing below several different slices. The one place where we are outperforming on an average basis is in the labor market, in the one place that we all know is both the last one to signal weakness in the economy, and it's also the place the Fed is watching for weakness in the economy. So we may have a chair of the Federal Reserve who is sidelined deeper into an economic softening than the market is currently expecting, and I think that that's one of the biggest wild cards of this whole saga, and that many people will just be dead wrong about. So we'll continue looking at this data in the coming months. You guys know that we'll unpack this in a bunch of different ways. I'll look for opportunities for us to look at price charts, to look at on-chain, to not forget about the other aspects of the market and crypto and everything else that we talk about on this channel. We're not just going to become a bunch of recession doomers. But I think that there are a lot of ways to unpack this data. As new data points come in, it will give us reasons to go back to old charts. And this is the most important story right now. I didn't talk about the SEC and XRP this last week. I didn't talk about Larry Fink mentioning Bitcoin and crypto on CNBC, because I think that those are minor addendum stories to this bigger picture item on the screen in front of you. I know there are people who will disagree with that, who will think that the amount of speculative appetite we have, the quote-unquote cash on the sidelines that is always fabled, whatever the explanations that the bulls have, they'll always find some reason to not think think that this recession talk is that important and that I'm missing the bigger picture because I'm not talking about how the NASDAQ is only 10% from all-time highs. And that's interesting. Sure, the NASDAQ's going higher. That's cool. But that's what everyone is talking about. You don't need me to tell you that. I would rather talk about what other people are ignoring or simply not appreciating. So that's where I will continue to approach this market. I want to find where the story is not being told. And that doesn't mean that we'll be left behind by whatever shifts happen in the market. So we'll find places to talk about the market where it makes sense. But whenever I find new items that relate to this thesis here, I'm going to make sure I show them to you guys and we talk about it. Looking out at the economic calendar, we have a bit of a quieter week relative to last week. We'll get some updates on things like retail sales, industrial production, and some pieces of the housing market, but that's it. So we'll give this a little time to breathe. We'll see if these crypto rallies are able to sustain or if all the talk of alt season is going to be squashed again like it was a couple months ago. And maybe next video we'll have something to say about some of that. Make sure you follow me on Twitter right here at TXMC Trades. And that's where we'll leave it this week, my friends. If you have questions or feedback for me about this channel or what you saw today, make sure you leave a comment to the video and I will see them. I go through and approve all of them so that I can weed out the bots. I've been wanting to do a live stream, but my office has been a major mess, and so I haven't wanted to get on the webcam just yet until I clean up some of this. We've been doing some remodeling in my house. But when I get this sorted out here and it doesn't look like such a disaster behind me, then we'll do a live stream and I can get on camera and we can have kind of a more chill video. But I'll make sure to let you guys know more than a day in advance so you can schedule it and remind yourselves if you want to be there. And that's it. That's what I wanted to talk to you guys about today. I'm going to let you go. So until the next time we chat, take care of yourselves, friends. Take care of each other. You know the drill. And we'll chat with each other in just a few days. Cheers, everyone.